Good morning, everybody. This is Bob Meath, and with me this morning is Carrie Meath-Sinkin. We are recording this update on Sunday morning, March 29th. And before we get started, I'd like to kind of update with you on what we've been doing the last couple of weeks. As you know from previous communications, we've been working in our home offices for the most part. In fact, this morning, both Carrie and I are recording this from each of our individuals' home office. We have been going in the office for doing basic necessities like picking up mail and just doing some things that we need to do at the office. But for the most part, we've been working at home. We've also been going through all your plans, making sure everything is okay, just checking to see if there's any opportunities that we can take advantage of at this time. As you know, I feel like our goal-based process is really built for times like this. The process, as you know, centers on identifying your goals and then developing strategies that align with those goals. For example, you know, if you're currently in retirement, we have strategies set up for retirement income that give you a very high confidence factor that you'll achieve those goals. You know, our process is really centered on providing the highest confidence factor that you achieve your goals, and all of our strategies are aligned to that. I'm going to turn this over to Carrie currently, and she's just going to go through what has happened on the coronavirus and what are some facts, and then I'll come back in at the end and talk about what we see as some opportunities.
Hi, everyone. Nice joining you this morning. So as my dad was saying, we just wanted to provide you with an update on really what's happening in the markets, what's causing it, and what are some opportunities that you can think about. Obviously, there's a lot of unknowns right now, and so we just wanted to help you provide you a little bit, at least on the financial side. So what's happening? Let's start by looking high level at what's been happening in the U.S. markets and economy. On March 11th, 2020, the Dow Jones Industrial Average entered a bear market for the first time in 11 years. The next day, March 12th, 2020, the S&P 500 and the NASDAQ followed suit. The term bear market, as you know, has a simple definition. It means securities have declined by 20% or more. The recent market drop ended the longest bull market run in history, and as of March 13th, 2020, the S&P 500 was down 16.09% year to date. Stocks had already dropped into correction mode, defined as a pullback of 10% late in February. And in response on March 3rd, the U.S. Federal Reserve implemented a surprise rate cut. The preemptive move surprised many because the Fed's policy-setting meeting was just a few weeks away. The policy change seemed to spark anxiety among investors, and as we know, the Standard & Poor's 500 index, which had gained about 4.6% the day before the rate cut on Monday, dropped 2.8% on the day of the cut. The following week, the Fed announced it would inject $1.5 trillion into the economy, and we're going to be talking about that more in just a minute. And optimism about a robust public policy response caused the S&P to surge, and we've been seeing pretty significant moves daily. A bear market, by definition, is a backward-looking term. So what is important now is to understand why the bear market occurred and what the likelihood is for a recovery. The first 2 weeks of March alone have been enough to make everyone, a little bit anxious, and in the last few weeks as well. Daily swings up and down have been a lot for all of us. As an example, after their worst session since 1987 on March 12th, stocks posted their best day since 2008, just one day later on March 13th. And then other notable economic happenings from the last month include a robust employment report that was largely ignored by the markets, global equities posting their worst week since 2018. Probably the most important is the Fed announcing the surprise rate cut, but then more recently, the passing of the CARES Act, or the Coronavirus Aid, Relief, and Economic Security Act, which was passed into law on Friday, March 27th. It includes $2 trillion in relief funding, tax breaks, and loans for individual Americans and businesses impacted by COVID. This is one of the biggest spending bills to have passed, and is aimed at providing relief to millions impacted by work stoppages, health concerns, and financial hardship caused by the coronavirus. The CARES Act consists basically of 6 main sections: employment, individual business assistance, support for the healthcare system, economic stabilization, and relief funds. And we're going to be coming out with more in the coming week or two, really outlining some specifics on this, but just this is a big deal that happened on Friday. The dollar also posted its best week ever since 2018, and the U.S. Announced it would step up purchases for strategic oil reserves. So needless to say, there's been a lot going on this month, and nobody has a crystal ball, so we can't say for sure what's going to happen moving forward. Here, though, just remembering a few pieces. Bear markets are not all that uncommon. This is the 10th bear market for the S&P since 1950. Now, it is also important to point out that this time is different than all the previous bear markets, just like every other bear market was different from the ones before. Different events, time periods, rates, and economic factors impact the market. Current markets are being impacted by global issues, and it's important to remember that traditional economic theory suggests people buy into the market based off of the information they have. So as new information relating to the market comes available, the markets will adjust. Now, with concerns about productivity, economic outputs, growth, and a desire for cash in uncertain times, people, as we're seeing, are reacting to the markets. We also live in a world where information is faster than any other point in human history. Information can travel around the world in literally the blink of an eye. This allows markets to react faster than ever before, both on the upswings and on the downswings. When you look at the last month, the largest upswing in the market occurred in the past decade, along with the largest drops in a decade. In the same month, markets will continue to go up and down, but we don't, of course, know how that's going to unfold. It's also important here to remember that market timing is almost impossible. People do not know how or when to sell out at the top and when to get back in at the bottom. Well, some people may, try to. It is, it's hard to do with any level of certainty. The issue becomes when you do sell out, if you miss out on some of the recovery, you might not get back what has been lost. Therefore, that makes selling pretty difficult at times like this. It's also important to understand the long-term impacts of a down market and how recovery needs to work. Recovery in bear markets is typical, but not always longer than the downturn. Sometimes we get a V-shaped recovery, quick down, quick up. But really, we've been listening to a lot of calls, and it's uncertain how this is going to continue to move forward. But remember, 20% down isn't always 20% back up. It's, 25%, and 25% down is, you need 33% to get back up. So when you think about investing, it really is a long-term play. Now let's touch base just a little bit about what's causing this recent market volatility. We know the coronavirus is a health emergency, and while the virus itself, it is causing a lot in the markets. And it is the response needed to counteract the virus, slow its spread, and ultimately protect people that's really impacting things. Plain and simple, uncertainty seems to be driving volatility right now, and there's still a lot we don't know. First and foremost, as I'm sure you've been hearing about, the complete clinical picture with regards to COVID is not yet fully known. But health officials and organizations throughout the world are working, as we've heard, around the clock to try to understand more about the virus. Economically, we also don't have a full picture for the level of disruption we'll see to supply and demand caused by the coronavirus and the steps public and private officials are going to be taking to slow down, the spread and the impact that has. We know the world is global. Many things are manufactured using just-in-time processing. And when supply chains are disrupted, manufacturers may not have supplies needed to produce goods, so the plant production slows down or almost completely stops. We know the travel industry is likely to see a large disruption due to travel restrictions, event cancellations, and personal discretionary changes, and many other industries are being affected. As businesses and schools close, which we know is in full effect here in Minnesota, and we practice social distancing. We're all experiencing just a different way of moving through our days. In addition, fear and uncertainty are likely to continue to drive human behavior over the coming weeks, and all of these actions can cause an economic slowdown. The possibility of that slowdown and possible recession has caused the market to sell off, and because markets dislike uncertainty and nobody knows how long it's going to take to stop this pandemic, we do know, once the vaccine becomes available, there's a little more going into play there, but we still don't really know in the near term. The markets are volatile, and as we try to understand the impact of the virus and what the impact is going to be on the economy and the markets, and just what actions the governments are going to take and really the impact that those are going to continue to have. Often people say, to take the emotions out of investing, but, we are humans and we do have emotional reactions to things. Human behavior is very important to us. So emotions can actually help, inform decisions. Fear, uncertainty, and loss all help us make decisions in life. Fear can drive our decisions, uncertainty can create hesitation, and loss can be painful, so we try to avoid it. In general, people are loss averse. This means we feel more pain from loss than we do from pleasure from an equal amount of gain. For instance, for the average person, if you lose $1, it is 2.5 times more painful than the pleasure you get from the $1 of gain. This behavioral bias is known as loss aversion, and it often causes people to react in ways in an attempt to avoid loss. But if we only look at loss in the short-term perspective, we might actually be increasing our overall losses. So it's important to understand loss, fear, and uncertainty, what's driving them, and what we can do in the long term to best put us and our family in a really good place for the long term. And of course, herd mentality can be a good thing, but it's not always necessarily a good thing to be part of the crowd. So this is just something that we look at as well. And it's always good to have a historical perspective to help us make good decisions. However, the markets just don't know if this is a once-in-a-century pandemic or not. This chart here just shows us, the stock market performance with certain pandemics that have happened over the last couple decades. Let's also look at how long bear markets have historically lasted. On average, a bear market for the Dow lasts 206 trading days. Well, the average bear market for the S&P 500 is about 146 trading days, according to the Dow Jones market data. As of March 14th, the Dow was off 29% from its February 12th record, while the S&P 500 and NASDAQ were down 27% from their February 19th peaks by March 13th. Again, the past does not predict the future, but it can be helpful context to have when we look at what is currently happening in the markets. And of course, this is a good time to remember the words of Warren Buffett, who said, remember that the stock market is a manic depressive. Equity markets can swing wildly from day to day. We've seen a lot of volatility in the last few weeks, and we, think it's likely that we have more in store in the future. So while it's certainly difficult, it's important to not get caught up in all of the ups and downs, and to really always take a step back and come back to that plan. So that leads us. Yeah.
On that theory, Warren Buffett's also one of the first people to say that, the stock market, being a market, is the only place that people want to sell when the market's down. Usually you're looking, when you go into a store, you want to buy when things are on sale. But he has often said many times that this is when you get buying opportunities, and it's so just the moral is be patient, or be patient at a time like this.
Yep. So the question is, kind of knowing all of that, what are some things that you can use to keep in mind? Here's a few things just to, keep in mind before we go more into opportunities. So first, of course, avoiding fear-based decisions. This is something we certainly talk about and try to provide education around. Staying the course, it can be really difficult to see account values go up and down, and we, of course, completely understand that. But if we take a step back and really remember the goals and what history shows us, it can be very helpful. Really keeping your eye on the goal, and that is why our goal-based process comes in so much in times like this, because it really is making sure that you can achieve your goals, and we have you set up to do so. Trusting the plan and of course, taking advantage of opportunities. So market volatility and downturns can sometimes offer great opportunities like refinancing debt, minimizing tax implications of Roth conversions. And that's really what we're going to be talking about here in this next section. What are the things that you can be thinking about and taking advantage of during times like this? So with that, I'm going to turn it back over to Bob to go through what some of those key opportunities are and how we're looking at those.
Great. Thanks, Carrie. That was a great update on kind of what's happened and where we are now. I would just like to say one more thing on what the government has been doing at this time. There's basically two tools that are used at times like this to help in a recovery. One is fiscal policy, and that's controlled by the Congress and the president, and the other is monetary policy that's controlled by the Fed. And both those players have been very active. As Carrie mentioned, the Fed has been lowering interest rates. In fact, the Fed rate's down to zero, the short-term rate's down to 0%, and the 10-year Treasury is right around 60 basis points. And that's really the rate that mortgages are based on. So they've been very active on getting rates down. In addition, they've really done a lot of quantitative easing like they did back in 2008 and 2009, and that's where they basically are supporting and buying bonds to support that market. And then Carrie also mentioned the government being very active, and that's really on the fiscal policy, and that's where they can control what they do with the taxes. And as you know, they've just passed a huge $2 trillion package to help support the economy. We think that's going to kind of have the effect of what they're trying to do is just put the market in suspended animation, meaning just kind of keep it where it was. And by putting these supports in, they're hoping to do that. So the two parties have really been very active on the fiscal and the monetary side. When we look at key opportunities, as I mentioned earlier, we've been very active in looking at accounts and looking for at different ways we can take advantage of a market like this. And these are just some of the things that we think are the ones that are kind of on our checklist that we're looking at. One is a Roth IRA conversion. With some laws that were passed earlier this year, the retirement laws, Roths have become more advantageous than traditional IRAs for a number of reasons. But when you do a Roth conversion, and we'll talk more about this, but it's a better time to do it when the markets are low, and we'll talk about reasons for that. The other thing we've been looking at in clients' accounts is tax loss harvesting and rebalancing accounts, and we'll be talking more about that and the reason why that's advantageous to do now as well. On the trust and estate side, certainly gifting. There's some advantages of doing gifting when the markets are low. On the charitable giving, kind of the same reasons, and we'll be talking in detail about how we do that. Refinancing opportunities, obviously with these rates being very, very low, it'll be a good time to look at your mortgage, if you have a mortgage, and determine if it makes sense to refinance. And then also for some people, it'll be looking, it may be beneficial to turn Social Security on early. Usually we always advise to wait to full retirement age for the most part, or wait till age 70. But in some special cases now, it may make sense to turn Social Security on earlier. So on the Roth IRA conversion, the reason that it makes sense to look at now is that as you know, when you do a Roth IRA, when you do the conversion from a traditional to a Roth, you need to pay tax on the amount of money you've taken out of the traditional IRA. And obviously with these accounts being lower, the tax cost will be lower. So right now is a great time to look at Roth IRAs, especially if we can do some other ways to control income in the year that we're converting to Roth. So that's one thing we're looking at for clients. On the tax loss harvesting, basically what that centers on is that for a lot of you with non-qualified accounts, when we rebalance, we always have to weigh the tax cost against the benefits of rebalancing. But now with the account values being down, it gives us an opportunity to do more active rebalancing. So that's one advantage. The other thing is just on transitioning portfolios. For a lot of clients that have concentrated stock positions, this is a good time to look at diversifying into more diversified strategies that are more aligned with your risk and your return objectives. And the reason is that, once again, the market's down, so there's less of a tax cost in making that transition. So we're looking at that for clients with concentrated positions, but also for clients that are newer clients where they've brought in, I'll call them legacy assets, but we want to align them with the strategies that we think are appropriate now, but we haven't been able to do that as much as we'd like because of the tax cost. And now the market is down, so we're looking at transitioning those portfolios once again to strategies that are more aligned with their objectives. In addition, we always just look at a time like this for, are there ways, some losses we can take just to save you on taxes as well. On the trust and estate side, obviously, gifting may, for those of you that are doing gifting, this is a good time to do that because the markets are down. So if you do a gift of $15,000 when the markets are down, and assuming the markets will come back, that could end up being a $25,000 gift. So it amplifies the value of your gift. So we're looking at strategies. We're doing gifting now rather than waiting till later in the year. On the charitable giving side, it's really the same kind of thought there, is that this is a good time to be giving because you can amplify your gift by giving now. But also it may make sense to, whereas before we would put, we would many times gift stock to the charity, and the charity can sell the stock and not pay any tax. But maybe it makes sense now to look at stock and see if there's some losses, sell that stock, take the loss, and then gift to charity. So it kind of reverses some of that. However, for most of our clients, we still think, just because of the new standard deduction being so high, that donor-advised funds are probably the best way to do a lot of your gifting. But we are looking at that as a strategy. On the next part, the refinancing, obviously with rates being low, as I said earlier, a lot of your mortgage rates are based upon the 10-year Treasury rate, and that's low now, but I think it may even go a little bit lower. So this is a great time to be looking at refinancing if you do have a mortgage, just simply to lower your payments, and it may be an opportunity to take advantage of. And then the last thing is on Social Security, and the idea being there is that for most people, it always makes sense to, on Social Security, there are some different strategies that we use, but for kind of in general, you wait till full retirement age to maximize your Social Security, or you wait till even to age 70 before one of you may start Social Security. But with the markets being down, and it may make sense to start Social Security earlier with the idea that the market will come back and we'll get more growth by letting the assets grow back than we would if we on waiting on Social Security. So that's another strategy that we're looking at currently. And those are the opportunities. There's other ones that we're looking at, but those are the major things that we're looking through accounts right now and looking for those, how we can use those in your planning. Kind of as we wrap up, what I mentioned earlier was that we think our process is really built for these times. But Carrie, why don't you talk about this slide before I go into that?
Yep. So finally, and I know a lot of you already do a great job of this, but just a reminder to make sure you're moving your body every day, getting some exercise, whatever that looks like for you. There's a lot of great online resources available now. I'm happy to send them out if anyone wants some new ideas. But also just getting outside and walking is great. Getting enough sleep, 8 to 10 hours of sleep is always really helpful for our immune systems. Meditation or, times of silence, this is a great opportunity maybe to slow down a little bit. Keeping a gratitude journal. So this is really something I personally do every day, but it's making sure that if you do want to do it, that it's a different gratitude every day. And that helps, research shows that helps retrain the brain to look for things positive happening in your day. And then, of course, connecting with friends and loved ones. We've been doing a lot of Zoom and FaceTime calls with different groups, and while not the same as being in person, that's been helpful. So just make sure that you're taking care of yourself, and if we can be of help for you in any way, please don't hesitate to reach out.
Well, Carrie, I think actually right now when you talk about connecting through technology, I think Debbie, my wife, your mom, is playing Monopoly with Chris. So that's just, they're doing it online, but I can hear them laughing in another room, so they're having some fun playing Monopoly. We want to thank you for taking the time this morning. But as I had started earlier talking about, I think our process is really built for times like this. Our goal-based process is centered on really understanding what your goals are and having the strategies that are aligned with the right time frames. For example, if you need retirement income now, we have strategies that are providing that. If you need if there was goals that you had in the next 5 years, the dollars are invested much more conservatively to take advantage of that. It's the dollars that were earmarked for that 10 and 20-year period where we're seeing the volatility. But we knew that can happen, and that's why they were allocated out to that 10 to 20-year time frame to give them a chance to recover. So for most of our clients, as we go through this, we're just reviewing to make sure everything is still okay. And the other thing that's happened during this time period, just because of our process, is that we've had several clients refer people to us, their friends or business associates, because this is very much a time of uncertainty, and they're wondering if they're okay. So we've been helping some newer clients kind of understand what their objectives are and looking at their strategies. So certainly we want to invite you, if you have friends or business associates that are kind of uneasy right now, that are not sure if they're that they are okay, have them give us a call. We'd be happy to spend some time with them just to kind of make sure that they know where they're at and help them develop a strategy to kind of weather this storm, if you will.
Again, thank you so much for taking the time. We hope you're all staying healthy and safe. And as we've said previously, please reach out to us if there's anything we can do to help you during this perhaps a little bit crazy time. But thank you again.